Live from the Money Show in beautiful Seattle, Washington, I'm Adrian Manns, and I'm here with Janet Brown today of Fundex.com. So Janet and I were having a really interesting conversation a few minutes ago about the fact that the markets are booming, and a lot of investors aren't really there because they're afraid of risk and they've been afraid to get involved. I'd like to talk right now about, what do you see as the main driving factor that has investors sort of out of the market when they really should be in participating in this big rally?
Yeah, I think the great message, and you're right, investors have not been participating. There's always going to be uncertainty in the markets. I believe you should not let uncertainty hold you back. Markets change. The Fundex strategy is based upon adapting to these changes over time. So we spend most of our efforts at Fundex identifying what's working in the current market environment and applying that in a very disciplined way to follow changes in leadership. So don't let uncertainty hold you back. There's always something doing well. And investors, we were talking about they pulled $1.5 trillion out of equity funds and gone into bond funds while the S&P's up 400% in the last decade. Participate for long-term growth.
And what about the fears that investors have about risk? So how would you approach sort of mitigating risk in a portfolio for them?
Yeah, the first thing we do is look at the risk of all the no-load funds and ETFs that we invest in, classify them by risk, and advise our subscribers and our clients to put the majority of their assets in diversified market risk-like funds. One of the risks that I'm particularly interested in now is showing up in something called ESG, environmental, social, and governance scores. Help investors become aware of the material risks that companies have for some of the biggest challenges our world is facing now, including climate change, conflict, and inequality. These things have big effects on corporate earnings.
And what about, let's just say, the geopolitical stuff that goes on every day that has investors convinced that, tomorrow morning the market's going to drop 500 points and maybe it's going to keep dropping, right? What do you say to that person who's convinced we must be at a top and we're in for a big 20-30% correction?
Yeah, I would say to those people that the market goes up 2/3 of the time, corrections are normal, every year has 3.5-5% corrections, 10% correction, 20% corrections come. Markets are unpredictable. I believe it's unwise to sidestep long-term growth trying to time it. Even if you buy in at the absolute worst time, if you're going to stay invested for 20 years, you're better off. So I would advise most people saving for retirement to participate, but be aware of current market action, what's happening. Like right now, for instance, some of the funds that are bringing in the best returns are the lower volatility funds, like SPLV, excuse me. Cohen and Steers Real Estate, Fidelity Select IT Services. There are funds that are bringing in better returns. HDV is another one. But again, long-term participation is key.
All right. So for more great advice from Janet, take a look at Fundex.com. For The Money Show, I'm Adrian Manns.